Hello students. So students, we will start now on this last part on the capital gains. So I'll just quickly again will let you know the sequence in which we are going to discuss this entire CG part, the remaining part of the CG. First and the foremost part, students, is about the other two amendments which was in respect of the ULIP taxation, and the second one is in respect of the slum sale. So there are a couple of case studies which are there, students. We will look into that quickly. That is the first part. Second part, students, would be in respect of the taxation in respect of the non-resident and the capital gains like FII, NRI and all. So that is the second part. The third part would be some of the points on the exemption series of 54, and the last one would be couple of questions we will discuss in respect of the amalgamation and demerger on the capital gains front. So this will cover up your capital gains comprehensively. The first one, students, directly on the ULIP part which has been there, the ULIP amendment which is there. I'll directly will take you through to the situation, students, so that without now like wasting time on the concept part which we have already discussed earlier also, but directly I'll make you understand through a practical question itself. Let's look upon to this. Students, we all are aware that there is a 1010D. 1010D primarily talks about the case wherein the any particular in the case when you have taken an insurance and the insurance premium does not exceed 10% of the sum assured, not the proceed amount. Ritu, Pranam. So students, if this does not exceed 10% of that particular sum assured, if your whatever premium that you are paying, so whatever is the premium that you pay primarily, we all know there is one exemption of 1010D. So in this particular context, if your annual premium does not exceed that 10% of the sum assured, then in that particular case, whatever is a maturity proceed, that maturity proceed is eligible for the purpose of exemption under section 1010D. That is the position that you all are aware. Now, what they have done in this amendment, students, all we are aware that all the high value premium that is paid, the high value annual premium which are paid, so in respect of the high value premium which are being paid, even if the premium amount that you are paying is within 10%, is below 10%, is not going beyond 10% of the sum assured, of the sum assured, people used to say that even in these cases, the exemption of 1010D would be available because my annual premium does not exceed that particular, the 10% of the sum assured. And therefore, in those cases of the high value premium, primarily, wherein you pay a very high value of annual premium, but the fact is that it does not exceed 10% of the sum assured, you will still be eligible to take the exemption under section 1010D. Now, henceforth, this particular point will not be applicable because of this amendment. And just quickly the amendment, and there directly I'll take you to 2 or 3 questions. Small questions are there, and that should be all. So with effect from assessment year 21-22, that is actually from the last AY. This is bit of a case of a retrospective. 1010D shall not apply to a ULIP issued on or after 1st of February 2021 if the amount of premium payable for any of the previous year. So please be careful, students. This is very important. This is an MCQ based question that could be targeted. This high value premium concept which is introduced with effect from assessment year 21-22 will be applicable only in respect of those particular insurance policy which is issued on or after 1st of February 2021. Keep in mind this data. So if I've got an old policy for which I'm paying the high value premium, the old concept wherein I will see only 10%, whether this premium which I'm paying, is it exceeding 10% of the sum assured, that old concept will continue to apply. So that is the point. So with effect from assessment year 21-22, exemption 1010D shall not apply to a ULIP issued on or after 1st of February 2021 if the amount of premium payable for any of the previous year during the policy exceed 2.5 lakhs. Okay, so that is the point. So this is for one policy. This is for one policy and this is for the aggregate of the policy. So say one policy, so for there is a one policy, if I have taken, say for example, and that particular premium in this case, if it exceed the amount of the premium, even if it is below 10% of the sum assured, but if the amount of the premium paid is more than 2.5 lakhs, then in that particular case the exemption under section 1010D will be denied. Is that clear? Supposingly, students, I have taken on or after 1st of February 2021 3 policy, and the annual premium of each of the policy is rupees 1 lakh each. 3 policy and the annual premium of each of the policy is rupees 1 lakh each. The premium which I am paying for each policy, that does not exceed 10% of the sum assured. The premium which I am paying for each policy, that does not exceed 10% of the sum assured. Then what happens? Individually, in this case, the amount of premium does not exceed the threshold of 2.5 lakhs. But if I do the aggregate, then in that case the aggregate exceeds 2.5 lakhs. So in this case, if 2 or more ULIP have been taken by the person, the exemption shall be available only if, in respect of those whose aggregate premium, only in respect of those whose aggregate premium does not exceed 2.5 lakhs for any of the previous year during the policy term. So that is a 2 point that has to be kept in mind. Okay. Now just quickly 2 points, then directly practical question. So there is a case wherein, guys, you can also take a note of this one. So policy issued, this is a fundamental part. Policy issued on or after. This is an important chart, students. Let's make this chart comprehensive, students. Just all of you will take this particular chart. This is on the day of the examination. Just in a 5 minutes time, you can revise this particular part. So I'll just quickly make a chart for you here in a small one, and you can just look up onto this. Policy issued on or after 1st February 2021. This is the question. ULIP policy, unit link insurance premium. So it is like unit link means it is linked with this equity shares and all. The answer can be yes or the answer can be no. So I will just write first no. If the answer is no, the old provision would be applicable. What is the old provision? Whether the premium paid exceed 10% of the sum assured. So it can be no, it can be yes. If it is no, exemption under section 1010D available. If it is yes, then no exemption under section 1010D plus capital gains under 45(1) read with section 112. Capital gains would be applicable primarily under section 112. CG calculation, I'll just tell you how the CG calculation will go. The amount received on maturity minus to this the insurance premium paid. This would be long-term capital gains. Okay, so just keep this particular point in mind. Capital gains 45(1) read with 112. How the capital gains will be calculated? Amount received on maturity minus from that insurance premium paid. This would be your long-term capital gains. Now, if the answer is yes, whether the premium paid or the aggregate premium paid exceed 10%. Exceed 10% of the sum assured. Now here answer can be no. Or it can be yes. If it is yes, then 10(10D) exemption is not applicable. If it exceeds, students, 10(10D) exemption not applicable. Plus what? Plus CG under section 45(1), read with 112. Read with 112. And if the answer is yes, now this is very careful. If the answer is no, then in that case, whether the premium paid or the aggregate premium paid exceed rupees 2.5 lakhs. This is the point. So even if it is not exceeding 10% of the threshold amount of the sum assured, even if it is not exceeding 10% of the sum assured, you have to ask this question. Fine, not an issue. Check next question. That does the premium paid on the individual policy or the aggregate of the premium paid on all the policies issued on or after 1st of February 2021, does it exceed 2.5 lakhs? Does it exceed 2.5 lakhs? So for that, again the answer would be yes or no in this case. So if it is yes or no. So if it is not exceeding this one, friends, then simply put, the exemption under 10(10D) is available. But if the premium paid, so this yes, students, would be when the individual premium or paid is not exceeding 10% of the sum assured. It is not exceeding 10% of the sum assured, but the amount which you have paid for the premium, annual premium, is going more than rupees 2.5 lakhs. So if the answer is yes over here, then in that particular case, students, the exemption again under 10(10D) not available. Plus, now here be careful, the capital gains shall be calculated. The capital gains shall be calculated as per section 45(1)(b), read with section 112(a). Just take a note of this one. If you all are through, students, I'll directly take you through the practical questions, and then ULIP is done. We will go to the buyback line. If you all are through with this, directly one practical question, small question is there, and thereafter immediately we will go to the buyback part. Fine. So if it is yes, students, then in that case exemption 10(10D) not applicable, plus what, the capital gains shall be calculated as per section 45(1)(b), read with section 112(a). Now let's have a look, students, over here. The question which I was talking about it. This is a question. 4 situations are given to you, all of you. Obviously, assuming that the policy is taken, students. Policy has been taken on or after. In all the cases, the policy has been taken on or after 1st of February 2021. So let's have a look. Annual insurance premium 2.4 lakhs. Is it exceeding 10% of the sum assured? No. 10% means 3 lakhs. So is it exceeding 10% of the sum assured? No. If the answer is no, then the next question is, does the premium amount is going more than rupees 2.5 lakhs? Again, the answer is no. So whether the exemption under 1010D, is it applicable? And the answer is yes. And the answer is yes. Let's have a look to situation number 2. Just a second, friends. In this context, so over here, if you all have a look in this scenario, students. So over here, if you see, students, in this context, situation number 2, annual premium is 2 lakhs. Annual premium, students, is 2 lakhs. Now if you compare this with 15, now how much is 10% of sum assured? 10% of 15 lakhs is 1.5 lakhs. So does it exceed this 10% threshold? Yes. So if it is exceeding, straight away what is your answer? You will not even look. Students, one thing, please be very careful. If your annual premium exceed 10% of the sum assured, please pay attention, this is very important. If your annual premium exceed 10% of the sum assured, then you will not even look into what is the actual amount of the premium paid. Simply put, what you are going to say, since your premium exceed 10% of the sum assured, 1010D is not available, and the capital gains would be calculated under section 45, read with section 112. So that is what it is. Premium exceed 10% of the sum assured? Yes. Exemption 1010D is not available. Capital gains shall be as per 45. This is important. Read with 112. You will not go to this next section. Huh? See the third, because this is very important. Now see situation number 3. Situation number 3. How much is 10% of the sum assured? In situation number 3, 3 lakhs. How much premium you are paying? 2.6 lakhs. So therefore, the annual premium paid is less than 10% of the sum assured. Annual premium paid is less than 10% of the sum assured, isn't it? But in this case, what will happen? The amendment would be applicable. Why the amendment would be applicable in this case? Because the annual premium exceed 2.5 lakhs, and because of the amendment, this is very important. Because of the amendment, students, what will happen? Now your capital gains will be taxable under 45(1)(b), and the capital gains will be calculated under 112(a). This is how you have to look into it. And this is important. This is very important. The fourth situation. And what is that fourth situation? Situation number 4 is sum assured is 25. Annual premium is 2.6. Now if you talk about 10% in this context, please tell me, does it exceed 10%? Yes. What did I told you just some time back? Students, what did I told you just some time back? If your annual premium exceed the 10% of the threshold, then will you also see the 2.5 lakhs criteria? Answer is no. Even if it is exceeding 2.5 lakhs, but that will now become irrelevant for us. Because the basic particular exemption condition of 1010D itself is violated. And what is the basic condition? That your annual premium is exceeding 10% of the sum assured, and therefore you will not even look into the amendment part. Simply put, this 1010D available is not applicable, and the chargeability would be under 45, read with under section 112. Is that clear to all of you, students? The capital gains would be under 45, read with 112. One last question, students, small question, and then we proceed to buyback. We will proceed to slum sale. The slum sale was after this. Let's have a look to this one. So here, there are two policies which has been taken, and in this case, in these two cases, the amount does not exceed 10% of the sum assured. So obviously, it implies that the old this one 10% does not exceed. So as per the old law, without applying the amendment, exemption of 1010D is available as per the old law. Without applying the amendment, 1010D is available, because you will say that because the annual premium does not exceed the 10% of the sum assured. But let's have a look here. Please be very careful. The premium that you are paying, 2.5 lakhs, 2.4 lakh, 2.4 lakh. So individually, if you see, it is also not exceeding the threshold of 2.5 lakhs. Now let's have a look what happens after this year. Even this third year, fourth year, not an issue. Third and fourth year not an issue because it is still 2.4 lakhs. Not exceeding that 2.5 lakhs the premium amount. But in the fifth year, what happens? 2.4 lakhs plus 1.9 lakhs. Can you see this one, students? Now, therefore, although the annual premium is less than 10% of the sum assured, but in the fifth year, what we are finding is that aggregate of the premium paid on the policy issued on or after 1st of February 2021, the aggregate premium is going more than rupees 2.5 lakhs. And if it is going more than 2.5 lakh students, in that particular case, in year number 5, there would be some consequence. And what is the consequence, students? Let's have a look. So expected maturity amount they have given to you for policy number, this is 14,19,000. And the expected maturity amount for this one is 17,90,000. So that they have given you the maturity amount. That is perfectly fine. Now, if you see X wants to know whether tax exemption of 1010D shall be available in the aforesaid case, he does not take any other ULIP in the future. Let's have a look to this solution and we will then move to the buyback. As the annual insurance premium does not exceed 10% of the sum assured, exemption cannot be denied under section 1010D. That we have already discussed, the old provision, without applying the amendment. Okay. However, the aggregate annual insurance premium during financial year 25-26 exceed 2.5 lakhs. Therefore, as per 5th proviso, exemption of 1010D shall not be available for the two policies simultaneously. This is important. So, what will happen in this context? Because aggregate, it goes beyond this. Now, it is up to Mr. X, the policyholder, to decide one of the two. In which particular policy he wants to take an exemption so that in the other policy, this will become taxable. So now he will have to take a call. So X may take exemption either for policy 3006 or for 9244. Please be careful. Many students would be under the impression that the exemption will not be available for both the policy. No, it's not that way, students. I will remind you again on one thing. That for each policy, the annual premium does not exceed 10% of the sum assured. So the basic exemption is intact. The basic exemption of 1010D is intact. But where is the violation? The violation is that though the individual premium amount of these two policy does not exceed 2.5 lakhs, but when I do the aggregate of the two for the previous year 25-26, then it exceeds the threshold of 2.5 lakhs. And because now that it exceeds the threshold of 2.5 lakhs, we come to the next point. And what is the next point, students? As you all are aware, in the next particular point that is to be discussed in this regard, students, is this that exemption then will not be available, but you will not be denied the exemption for both. You will have to pick up now only one. So one particular policy you can claim an exemption, and therefore the other policy will become taxable. So therefore both does not become taxable. Just this is the point which I just wanted to reiterate in this case. Only one you will have to take an exemption, so that other is taxable. So obviously, students, it makes sense that for this 3006, this is 3006, policy number 3006, and this is 9244. It makes sense that I should take here the capital gains is less for 3006. Why? Because 14,90,000 is only my amount which I am receiving. 14,90,000 is what is the amount which I am receiving, isn't it? And minus with the 5 years premium, if I do, in this case, it roughly is around 12 lakh something, 12 point whatever it be. So that is the scenario, or maybe more than that. So capital gain is 2.9 lakhs. Whereas if I think of this one, the next policy is 17.9 lakhs. So if I do this 17.9 lakhs minus what? This 5-year premium. Ritu, can you give me the answer? 17.9 lakhs minus the premium amount. Then the premium amount. Then the capital gain is 8.4 lakhs. So obviously I would want to take the exemption for policy number 9244, which is this, and let the taxability happens for the first policy, that is 3006. So this is what it is in this case. So therefore, let's read this one. Therefore, as per fifth proviso, exemption under 1010D shall not be applicable for the two policies simultaneously. X may take exemption either for policy 3006, that is the first one, or for 9244. So it is advised that he should take the exemption for 9244 because the capital gains amount is huge. Okay, and pay the capital gains tax in the case of the first policy. I hope that all of you are clear with this one, and this is all about your ULIP. ULIP is done, students. Let's look upon to the slum sale now. Slum sale, students. The next amendment on the slum sale. Let's have a look, students, to that, and then we move to the NRI taxation. Slum sale, again an important one, students, for your upcoming examination. There is one practical question of the ICI module. Unfortunately, it is not covered here. Anyway, students, we'll do the practical itself because practical is important. Students, slum sale. This is expected, and that module question, students, I think that the module question, because ICI has given a question in the module, directly they will pick up that question from the examination. Directly they will pick up this question from the module itself. So my humble suggestion for all of you would be, just keep in mind that particular part of the amendment which is there in the module side. Let me see if it is. Yes, it is here. Let's see, students. The amendment, I'm just taking through the amendment PDF. Let me do this one. This is the ICI module. ICI question is also there. So let us have a look, students, over here itself. Now, in this context, students, there is one statement already made by me, and then one question is there. So, students, I will just quickly run through this one for all of you. Amendment PDF. It was already been done earlier. So, I will just in this context. So, slum sale, students, all of you are aware. There may be 2 units. In the case of 2 unit slum sale, one of the unit is being transferred without assigning the value to, without the transfer is made without the assigning the value to its individual assets and the liabilities. So if the undertaking itself is sold or transferred without assigning the value to its individual assets and the liabilities, then in that case, students, it will become a case of a slum sale. Then in that case, it will become a case of what, students? It will become a case of a slum sale. This is what is the concept of slum sale is all about. Okay, so that is how the things has to be looked upon. Now, generally, students, please pay attention here. When there is a slum sale, the amendment is in the computation of the capital gains. The amendment is in the computation of the capital gains. Now, how do we calculate the capital gains in this regard? So, the capital gains which is calculated, students, is like this. Full value of consideration primarily minus the cost of acquisition. Now, this computation is under 50B. Full value of consideration minus the cost of acquisition, and the cost of acquisition is taken as the net worth. The cost of acquisition, students, is taken as what? As the net worth. Fine. Now, where is the amendment? Now, let's look upon, I'll tell you before I tell you the amendment, let me tell you what is this net worth. The cost of acquisition, which is net worth, is, the net worth is assets minus liabilities. Asset minus the outside liabilities. Asset minus what? Asset minus the outside liabilities. This is what is the net worth, and which will become the cost of acquisition. This is what is your net worth, and accordingly that will become your cost of acquisition. Now, net worth, students, is asset minus liability. Now, asset will be divided into 2 parts. In respect of the depreciable asset, it will be the WDV. In respect of any other asset, it will be the book value without revaluation. Please pay attention here. The net worth, which is the cost of acquisition, net worth is asset minus the outside liabilities. So therefore, in this case, asset is divided into 2 parts. depreciable asset, it is WDV. The non-depreciable asset, it is the book value. Book value without the revaluation effect. That is what we do. Fine. So this is up till now it is all fine. So therefore, where is the amendment? Amendment is in the full value of consideration. Now the full value of consideration for the purpose of the slum sale 50B computation is higher of the two. It is higher of the two, and higher of the two is the fair market value 1 versus fair market value 2. Higher of the two is fair market value 1 versus fair market value 2. So where is the amendment in the respect of slum sale? It is fair market value, it is in respect of the full value of consideration, which is now higher of the following two, which is fair market value 1 compared with fair market value 2. Now if I go with this particular proposition, students, fair market value 1 would be primary. Now just pay attention. Fair market value 1 is, again, students, it is the valuation of FMB 1 is nothing but, it is a simple word, students. Fair market value 1 versus fair market value 2. Fair market value 2. So fair market value 1 is the valuation of the net asset. Net asset of the undertaking. Undertaking transferred. As simple as that. Valuation of what? Valuation of the net asset of the undertaking transferred. This is fair market value 1. Versus fair market value 2 is the valuation of what? Consideration received. In a simple word, so that you can remember, revise this way. Consideration received. The valuation of the consideration received. So in this case, students, in the context of this slum sale, as I told you, where is the amendment? It is not in the cost of acquisition. Cost of acquisition is net worth. Again, please be very careful. Cost of acquisition is the net worth. What is net worth? Net worth is the asset minus the outside liability. And therefore, asset is divided into two parts. Depreciable asset, WDV. Non-depreciable asset, book value without revaluation. This is your asset minus the outside liability, which will fetch you the net worth. Net worth is your cost of acquisition. Keep that aside now. Focus on the full value of consideration. So the full value of consideration now is the higher of the two amount, which is the fair market value 1 and fair market value 2. Fair market value 1 is nothing but the valuation of the net asset of the undertaking which you have transferred. So whatever undertaking that you have transferred, you need to do the valuation of the net asset. And fair market value 2 is the valuation of the consideration that you have received. This is how it is. Now with this, directly I'll tell you, let's look upon to this. So in this case, students, as I told you, full value of consideration is the higher of fair market value 1 and fair market value 2. Now let's have a look. What is fair market value 1? Equation, they have given it to you, A plus B plus C plus D minus L. It is very simple, students. There is a question, we will look into this. You'll say, sir, why minus L? Because just now I told you, fair market value of the valuation of the net, valuation of what? The net asset of the undertaking which has been transferred. So because it is a net asset valuation, so therefore the liability has to be reduced, isn't it? So that is the reason why minus L. And A plus B plus C plus D is the valuation of the asset. So this is about the valuation of the asset, minus the liability. So this will finally give you the valuation of the net asset. The valuation of the net asset. So this is what will finally give you the valuation of the net asset. Fine. So this is what it is. Now let's have a look to FMB value number 1. Now they say, simple put, students, simply put, book value of all the assets of the business undertaking minus the falling asset. Now students, please be careful. This valuation is just similar to what we do in the case of the fair market value wherever we have done in exit tax also. Remember, in exit tax also we used to do this, or for that matter we used to do in the case of the other one. So this is actually in respect of that. Okay, it's just simply the way we used to do the fair market value calculation. So it is book value of all asset of the business undertaking minus the falling assets. Now all these cases, every time these assets are out from the game. You all are aware, these assets are out of the game. Jewelry, shares and security, immovable property, and the income tax paid. Now you all are aware, because we don't take book value of these assets, we take the fair market value. Isn't it? We will take the fair market value. So therefore, these are the assets which are excluded. Again, what is excluded? So we will take the book value, minus from the book value the jewelry or artistic work, shares and securities, immovable property, and income tax paid. Remove them, and that for the remaining you get the book value, net book value. So this can be referred as what? This can be referred as net book value of, or students, the correct word is book value of net asset, that is with excluding the falling asset, the book value of the net asset, or the correct word for instead of net asset, the remaining asset, book value of the remaining asset, remaining, this is the correct word. Remaining asset. Fine. Now let's on the remaining asset. So what about the excluded asset? I told you about jewelry, the price which it would fetch if sold in the open market on the basis of the valuation officer report. Nothing but in a simple word, it is a fair market value. Jewelry. What about the shares? Shares as determined under Rule 11 UA. Don't worry, they will give you the question. In the question, they will give you what is the valuation as per Rule 11 UA. You don't have to worry and work out over here. So this is amount. Then the next one, students, is about the value adopted for stamp duty purpose. This is for the immovable property. For the stamp duty purpose, students, for the stamp duty purpose, whatever is the value which is adopted for stamp duty purpose in the respect of immovable property. So this is your D. So A is your book value of the remaining asset, plus B is the jewelry, C is the shares, and D is the immovable property. So A plus B plus C plus D, this is what you get it, minus L, book value of the liability as appearing in the books of the undertaking or the division. So whatever is the total liability, from the total liability you will reduce the shareholder fund, students. Whatever is the total liability, take the total balance sheet. In this case, simply put, students, take up the balance sheet value. Take up the balance sheet total. Balance sheet total liability, and from this balance sheet total liability you will reduce the paid up share capital, means simply put the shareholder fund. Thereafter you will also reduce the provision for taxes and the provision for contingent liability. So these two, provision for taxes and provision for contingent liability, also will be reduced, and thereby you will get what, students? You will get the L. This is your L is what you will get it. And accordingly now Fmb value 1, which is nothing but, what is the Fmb value 1? The valuation of the net asset, valuation of the net asset of the undertaking transferred, valuation of the net asset of the undertaking transferred. This is your Fmb number 1. Okay, so this is Fmb number 1. What is Fmb number 2? What I told you, Fmb number 2 is the fair market value of the consideration that you have received. Now, if the consideration if you have received is in money, your answer is simple. So directly take up the money value. So which is E. E is the money value, and thereafter F plus G plus H is all about the non-monetary consideration if you have received. So what could be the type of non-monetary consideration? What is the type of the non-monetary consideration received? So the type of the non-monetary consideration that you may have received is the shares and security, jewelry, paintings and drawings. So these are the cases of the same thing above, which we have discussed above. So that is F. G is about the immovable property. G is about the other movable property, like motor car, students. So that may be the G. And H is about your immovable property, then the open market value. So E plus F plus G plus H. So E is your monetary property. F and G is about the movable property, whereas F is shares and security, jewelry and painting. So this is about the movable property. And G is the remaining movable property. and thereafter H is about the immutable property. H is about the immutable property for which we take up the open market price. This is your FMV number 2. Take up the higher of the two, and that is the answer. Is that clear to all of you, students? Shall we do a practical now? This is a practical now in front of us. So students, over here if you see in this context, so let's have a look in this scenario. In this scenario, students, how the things has to be looked upon. So students, over here, now if we have to work it out in this scenario, so let's have a look in this context. So here, students, what they've given it to us is about the fact that unit 1 is transferred on 1st of April 2021 by way of slump sale for a total consideration amount is 14 lakhs. Now students, this is my Fmb value 2. Now this is the monetary consideration, so it is Fmb value 2, and this is E. E is how much? Say rupees 12 lakhs. So E, I have got it 14 lakhs. Now I have to see, apart from the monetary consideration, did I receive further any non-monetary consideration, namely the movable property or the immovable property? Then in that case we will have E plus F plus G plus H. But if the movable property and immovable property is not received, if movable property and the immovable property is not received, then your FMB2 would be rupees 14 lakhs, which is E. And this FMB2 of rupees 14 lakhs would be compared with FMB1, and the higher of the two will become the full value of consideration. FMB1, students, is what your FMB1, I told you already, is nothing but your FMB1, students, is nothing but, you all are aware, students, FMB1, you all are aware, is your valuation of the net asset of the undertaking which you have transferred. We'll see that. The expenses incurred for this transferred was 38,000. So this 38,000 will be reduced from the full value of consideration so as to determine the net sale consideration. Isn't it? So this 38,000 will be reduced from your full value of consideration. And what is your full value of consideration, students? Your full value of consideration is higher of FMB1 and FMB2. Your full value of consideration is higher of FMB1 and FMB2. Now, asset unit 1, unit 2 and total. Building has been given to you. Machinery value has also been given to you. Debtors and patent also has been given to you. In the case of liability, you have got own capital, revaluation reserve for building of unit 1, bank loan 70% for unit 1, and trade creditors 25% of unit 1. So that is the total amount which has been given it to all of you. Now in that context, students, if you all will see how it goes. So here in the case of the building, in this context, so unit 1 is a target. Be careful, unit 1 is a target. Now other information has been given to you. Revaluation reserve is created by revising upward the value of the building of unit 1. So revaluation reserve has been given to you. The stamp duty value on 1st of April 2021 is 10 lakhs. Students, in your FMB1, while you determine the valuation, which is A plus B plus C plus D minus L, in this context, we will have to look into the building valuation. Building valuation separately we have discussed already. And the building, in this case, if you see A plus B plus C minus D, so A, as you know, it is the book value minus the falling asset. In the falling asset, immovable property is removed to be valued separately. So in A, you don't take the immovable property. What about patent, students? Patent. Will you take patent in A or not? Because in your balance sheet in this question, you have been given the patent. So will you take patent in this case or not? Patent has been given to you over here. So in A, whether the patent will it come? when you do Fmb value 1 calculation, whether the patent will it come in A? To that the answer is yes, Ritu. And the answer is yes, students. In A, the patent value definitely will come. Now, will you take the WDV of the patent or the book value of the patent? Because below there is something that they will tell you about the WDV value of the patent also. So what should I take? For the patent, what should I take? Will I be taking the WDV value of the patent for determining my Fmb value 1? Or I should be taking the book value of the patent for the purpose of determining my Fmb value 1? It is the book value. Why I am emphasizing on this? Students, do you know why I am emphasizing on this? Because while you calculate Fmb number 1 for the purpose of, this is for determining the full value of consideration. For calculating the full value of consideration, I will do Fmb 1 compared with Fmb 2. Higher of the two is the full value of consideration. That is how we do it. Please be very careful now in this context. All of you will please be very careful on this one now. This full value of consideration would be minus with the cost of acquisition. And what is the cost of acquisition? I told you net worth. And what is the net worth? Net worth is primarily the asset minus liability, asset minus outside liability. This is what I told to all of you. Asset minus the outside liability. Now, asset I have told you into two parts. Which are the two parts? Herein is the depreciable asset. Then the depreciable asset. Then in the case of depreciable asset, we'll take the WDV value. And the other asset is the book value. So in this case, while you calculate the net worth, students, at the time of calculating the net worth, which is your cost of acquisition, will you be taking the patent at the book value, or will you be taking patent at the WDV? While you calculate the net worth, which is your cost of acquisition, at that time, will you be taking the patent at the WDV, or will you be taking the patent at the book value? It has to be at the WDV. And that is a difference which I just wanted to tell to you. So again, I'm closing this particular discussion on with this conclusion in respect of Fmb 1, which is to be considered which is to be determined for the purpose of full value of consideration. In Fmb 1, the book value is what is to be taken except for these 4 assets. Book value is what has to be taken except for these 4 assets. Therefore, that is the case in this assets. You don't have to go with the WDV, you will have to go with the book value. That is your Fmb number 1. I hope that this point is well taken by all of you. Every one of you are clear with this one. Don't make blunder, students. In the examination, chances are very high that you may make a blunder. So students, this is what it is. If I can just quickly, now just have a look. The next one, point number 2. No individual value of any asset is considered in a transfer deed. So if no individual value of any asset is considered as transfer deed, will it make this as a case of a slump sale? Because this is what just now I told you the definition of slump sale. And therefore, if no individual value has been taken, therefore we will say that this will be the case of a slump sale. Patent were acquired on 1st of July 2019, on which no depreciation has been charged. So students, in this case, the book value is 2.5 lakhs. But the WDV would be something else. And therefore, the book value would be considered for Fmb 1, whereas the WDV value would be considered for the purpose of determining the net worth, which eventually is your cost of acquisition. Now, just let's, students, quickly finish this cost of acquisition calculation first. The best is to do with the cost of acquisition calculation first, because that is very simple also. So if I just focus on the cost of acquisition calculation for unit number 1, which is the net worth, and in the net worth, students, what I need to do? In the net worth, students, in this context, simply put, what I will do in this context, there is a revaluation reserve which has been created. The revaluation reserve, so for the building, 13 lakhs. For the building, 13 lakhs. Minus the revaluation reserve. So revaluation reserve for building 1 is 5 lakhs. So therefore, whatever is the revaluation reserve, it is only for building number 1, unit number 1. So therefore, if I say the WDV, what is the WDV or the book value? It is 8 lakhs. So while I take up the cost of acquisition, I will go with 8 lakhs. So this would be 8 lakhs net of revaluation, excluding the revaluation. Machinery value is 4 lakhs. Machinery value is 4 lakhs, isn't it? Thereafter, the debtor students. Is how much? It is 2 lakhs. And the patent I have to calculate it. WDV value of the patent I have to calculate. So what is the WDV value of the patent? Directly students, you will go with this patent calculation over here. See the value of patent. 1st July 2019, 2.5 lakhs. Take up the depreciation for the financial year. Yes, depreciation for financial year is this much, and the depreciation for the next financial year is this much, so that you get WDV as on 1st of April, which is 1,40,625. So now with that, just have a look, students. Net worth calculation. Building 8 lakhs, machinery 4 lakhs, debtors 2 lakhs, and the patent is 1,40,625. So take the total is 15,40,000 this thing. And what did I told you? Assets minus the outside liability. Net worth is what? And what is the outside liability? Outside liability is here 70 per bank loan is outside liability. 70% is for unit 1. So it is 70% means 2,80,000. And trade creditor is 25%. 25% of 3,50,000. 3,50,000 students. And therefore in this context, 3,50,000. So 70,000, 25% of 3,50,000, which is 87,500. And this is 2,80,000. So my outside liability students is how much? 367,500. And net worth, which is the cost of acquisition, is 11,73,125. So now every focus now is only on FMB1 and FMB2, which is a full value of consideration. FMB2 already we know. Students, how much is FMB2? FMB2 is only the monetary consideration. So E plus G plus H, E plus F plus G plus H. E is your monetary consideration, F and G is for the movable property, and H is for the immovable property. So in that case, students, the consideration unfortunately is only of the monetary consideration. There is no movable property received as a consideration amount. There is no immovable property received as a consideration amount. So what is received is only 14 lakhs as the monetary consideration. So your FMB number 2 is 14 lakh rupees. FMB2 is your 14 lakh rupees. And let's look upon to FMB1 now. FMB1 A plus B plus C plus D minus L. Now in this case, A is the book value of all the assets. Now book value of all the asset students in this case, if you see very carefully now, the book value of all the asset students which has been there. Now the book value of all the assets which has been there, if you look into this, so I'll take A as this. Everything will be the A, isn't it? Everything will be the A. Now B plus C plus D, A plus B plus C plus D. B and C is for what? Shares and security and the mobile, jewelry and all. Jewelry is B, and the shares and security is C, and D is a mole property. So your B plus C is 0 here. Here B plus C is 0. So in this question, only A is given, book value 4, 6 and 8.5 lakhs. B plus C is 0. What about the D? So this is your D. D is what? Is a stamp duty value. Stamp duty value. And the stamp duty value is 10 lakhs. So A plus B plus C plus D students is how much? 4, 6, 8.5. Then in this case 18.5 lakhs. 18.5 lakhs is A plus B plus C plus D. And then minus the L. Now what is the L students? L, if you see, first of all, see the calculation of L. So 18.5 lakhs is A plus B plus C plus D minus the L. Now how you calculate the L students? As you all are aware, L. Take up the total of the balance sheet liability. And from that you will reduce what? The paid up share capital, amount of the proposed dividend, and shareholder fund minus the provision for taxation and the provision for contingent liability. So that is what has to be reduced. So I'll go with that now. Total is 29.5 lakhs. 29.5 lakhs. Minus this amount. Minus this amount, students. Minus this amount. Now the book value of the liability as appearing in the books of undertaking. Now in the books of undertaking, in the books of the undertaking or the division, okay, in the books of the undertaking or the division. Now unfortunately, students, in this question, in this case, we have given the combined liability. So I'll go with this 29.550 lakhs. I'll go with this 29.50 lakhs. And what I will do, students, in this case, in this case, I will remove this one, 70 lakhs and 5 lakhs outrightly from this. I'll remove 70 lakhs and 5 lakhs outrightly. And thereafter, because now I want that liability of the undertaking, the liability of the undertaking. So therefore, after removing from 20,50,000, after removing 22 lakhs, so how much is remaining? 7.5 lakhs. From 29.5 lakhs, I will remove 22 lakhs. What is remaining, students? 7.5 lakhs. Now, because I want the liability, L is the liability of the undertaking or the division which has been transferred. So obviously, I have to remove from this 7.5 lakhs the portion of the liability of the other undertaking. From this 7.5 lakh, students, I will remove what? The portion of liability of the other undertaking, because this is the combined value in which I am working out. So how much is the portion of the liability of the undertaking? For this 4 lakhs, 30%. So which is 1.2 lakhs. So from 7.5 lakhs, I will remove 1.2 lakhs. 1.2 lakhs. And this 75% of 3.5 lakhs is what I will remove it. So therefore, what effectively, students, I will be getting it in this context. See here, the liability 29.5 lakhs. From 29.5 lakhs, I have removed this too. I have removed 22 lakhs. I have removed 22 lakhs. And thereafter, from this 22 lakhs, thereafter I'll remove this 30% of that creditor, which is 30% of 4 lakhs, which is 1.2 lakhs. And 75% of what? 75% of 3.5, which is 2,62,500. So therefore, after removing this, my net L, finally the L is how much, students? L is 3,67,500. 3,67,500. So A plus B plus C plus D already calculated, 18,50,000. A plus B plus C plus D, 18,50,000 stamp duty value, and for all the remaining asset, book value. So 18.5 lakhs minus L. What is L? 367,500. 367,500. And after doing this minus L, finally I'll get what? Fmb value 1. Fmb value 1. So Fmb value 1 is 14,82,500, which will be compared with the Fmb value 2, which is 14 lakh. So finally your answer is Fmb value number 1. Again, I'm repeating the L calculation. The calculation for L, which has been there. So here, students, what did I told you? We started with this one, and from this we remove the profit, the capital and the profit. So 22 lakhs got removed. Now the fact that I wanted the L is the liability of the undertaking or the division which has been transferred. Now therefore, I have to also reduce then the liability of the other undertaking. And how much is the liability of the undertaking? 1,20,000 from the bank loan and 2,62,500 for the trade creditors. 1,22,000, 1,20,000 for bank loan and 2,62,500 for the trade creditors. So this from 7.5 lakhs, I'll reduce these two, and that will give me my L. And this L will be reduced from A plus B plus C plus D, which is 18.5 lakhs. And finally, I'll get my Fmb value number 1. And this Fmb value number 1 will be compared with Fmb value number 2. Higher of the two finally would be my full value of consideration, and that full value of consideration would be reduced from the cost of acquisition which we have just now calculated, and I'll get what? Students, finally I will get my slump long-term capital gains. Now don't forget this one. You will make one. Don't forget this calculation, students. Expenses on sale. The expenses on sale, because the net sale consideration, from the net sale consideration, so this is already you have worked out 1482. From 1482 minus the expenses on transfer and thereafter the cost of acquisition, finally you will get your long-term capital gains. I hope that all of you are clear. With this, now we go to our next part, students. Let's move to the next part. And the next part is NRI taxation. The non-resident, the ADR and GDR calculation, students. So this is our part 2 of our discussion. Again, very important for your upcoming examination, students. Be very careful on this one. Be very careful, students, on this one. On the NRI taxation, this is our second particular discussion. Students, this is what it is. The capital gains calculation in the NRI. As you all are aware, students, so far as the NRI is concerned, the taxation of the NRI, students, in this context, what we do, students, all of you are aware of this. All of you are aware of this one, students. Students, what happens in the case of NRI taxation is that, simply put, the non-resident, he will invest in. Students, the NR will be investing in what? The non-resident needs to invest. Which non-resident? Any non-resident or non-resident Indian? Any non-resident, or it is the non-resident Indian? It has to be a non-resident plus person of Indian origin. So this will make him NRI. The provision of Chapter 12A, students, is applicable only in respect of the NRI, the alternate scheme of taxation. So the NRI, students, would be using his foreign currency, and that foreign currency would be invested in the specified asset. That foreign currency would be invested in the specified asset. Now, once he invests in the specified asset, thereafter, the income would be two income that they have targeted in Chapter 12A. Which are the two income? First is the interest income, or maybe the dividend income arising from the specified asset. On this interest or the dividend income, the tax rate is 20% flat without giving the benefit of any deduction. 20% flat, students, without giving the benefit of any deduction whatsoever. That is point number 1. Second income is the long-term capital gains. The long-term capital gains arising on the transfer of the specified asset is taxable at the rate of 10% without giving the benefit of indexation. Without giving the benefit of indexation. So that is what is your second particular point, which is there for NRI. Now be careful here. These chances are very high that these specified assets that we are talking about, these specified asset, students, that we are talking about, are also taxable. These specified assets that we are talking about, students, are also probably can be covered in 112A. Because in 112A, what happens is that if you have got a listed security and which has been transferred in a recognized stock exchange on which STT has been paid, and the asset is long-term capital asset, then 112A is also applicable. 112A is also applicable. And if you know the computation of capital gains under 112A, how do we calculate the capital gains? You will do the calculation of capital gains without giving the indexation benefit. But more importantly, students, there is an extra 1 lakh exemption which is given in 112A, and the net long-term capital gains after the 1 lakh exemption, the net long-term capital gains after the 1 lakh exemption is taxable at the rate of 10%. Is taxable at the rate of 10%. I think all of you are aware of that. But an NRI opting for Chapter 12A, the NRI opting for Chapter 12A will not be eligible for 112A, which therefore implies that their capital gains would be calculated only as per what Chapter 12A says. And chapter 12A says what? For whatever is the cost of acquisition, you'll reduce that, no indexation. And there is no further 1 lakh exemption if you have opted for chapter 12A. There is no further 1 lakh exemption which if you have opted for chapter 12A. So you'll calculate the long-term capital gains without that further exemption of 1 lakh, which is there only for 112A. But if you have opted for chapter 12A, then 112A is not applicable. And therefore, this long-term capital gains without any exemption of 1 lakh, this long-term capital gains will be taxable at 10%. Okay, so just keep this point in mind because this is what ICAI has done in the past. Directly, students, we will do this question. Okay, by the way, couple of points. If the NRI does not want to pay the tax, so what the NRI can do is this, that students, he can reinvest the consideration amount. He can reinvest the consideration amount in the new asset. He can reinvest the consideration amount, students. Where he can reinvest the consideration amount? In the same specified asset. So reinvest the consideration amount in the same specified asset, and the period of reinvestment has to be within 6 months from the date of transfer. The period of reinvestment has to be within 6 months from the date of transfer. So if he does the reinvestment, then as per chapter 12A, the 10% capital gains, the 10% tax on the long-term capital gains determined as per chapter 12A, that 10% tax will not be applicable. So this is the exemption criteria. On that note, students, directly let's look upon to this question. We will then go do the other part. Let's finish this one. So on the day of the examination, students, directly refer this question. That's it. NRI is over. Long-term capital gain arising on transfer of the foreign exchange asset on 31st of July 2021. How much is the amount? 6.5 lakhs. Expenditure wholly and exclusively incurred in connection with such transfer is how much? 80,000. So that will be reduced because you have to get the net sale consideration, and from the net sale consideration you reduce the cost of acquisition. Now students, keep in mind this data, 31st July 2021. Interest on deposit held with the private limited companies. Interest on deposit held with the private limited companies. So this interest income, students, 5,90,000. So that will be at 20%. Interest on government security, 95,000. Now, but be careful whether this interest on deposit with the private limited company, this private limited company, is it been covered as a specified asset? Is the private limited company, is it considered as specified asset? Students, can you see this over here? I have deliberately put across here. Separately with this. This has been made separate and this has been made separate. Okay. So deposit with the private limited company is not what? A specified asset. For chapter 12A. So therefore this 20% that we are talking about it in chapter 12A. In chapter 12A, this interest income will not be assessed. This interest income will not be assessed. In chapter 12A, this interest income will not be assessed. Can anyone tell me then if in chapter 12A, this interest income cannot be assessed because it is not arising from the specified asset, then where this interest income will be taxable? Please be very careful. The fact that he is still a non-resident the fact that he is still a non-resident and he is earning an interest income the fact that he is still a non-resident and he is earning an interest income, students, such interest income for a non-resident is assessable under 115A, And what is the rate under 115A? If it is to go under 115A, students, where the interest income of a non-resident is assessable, what is the rate of tax under 115A for such interest income? The rate of tax for such interest income is 20%. No, Ritu, 20%. So if you see over here in this context, 20% is what has to be considered over here. Why is it that you have taken this thing? %, worth. But under 115A. This needs a correction, students. So tax on the balance income is rupees 5,90,000. As I told you, this happens to be an interest income. Also, this person is a non-resident. Yes, he is a non-resident. So, if it is an interest income of a non-resident, Chapter 12A may not be applicable because this is not an interest income arising from a specified asset. So, Chapter 12A is not applicable. But still, this interest income will go under 115A because interest income arising to a non-resident, that interest income arising to a non-resident is accessible under 115A, and that 115A, students, is 20%. I hope that every one of you are clear with this. A correction is required over here, students. Students, now let's take the discussion further. Interest on government security, interest on public deposit, these are specified assets. So this will go under Chapter 12A. These two will go under Chapter 12A, 20%. Dividend from domestic company, students, even this is Chapter 12A. 20% for this also. That is perfectly fine. So these three are from the specified asset. These three are from the specified asset, so we don't have any issue. 20% would be the rate as per Chapter 12A, and that is how the things has to be looked upon. Now be careful with the B part. Saving and investment. Investment in notified saving certificates referred in 10.4b on 30th of March. And investment in shares in Indian Public Limited Company on 31st of December. Students, can you see that? Both of them, be it 30th of March or be it 31st of December 2022. Both of them, if you compare from this date, is it going beyond 6 months? Answer is yes. And the fact that it is going beyond 6 months, students, you will not be eligible for the exemption which we have discussed under Chapter 12A. No exemption would be applicable under Chapter 12A. And if that is the case, let's look into the solution now. So long-term capital gains, 6,50,000, which you have calculated above. Now, expenditure on transfer of 80,000 would be reduced. So 5,70,000. Will there be any exemption in respect of these two investment? Will there be any exemption in respect of these two investment of 2 lakh and 3 lakhs? Answer is no. Why? Because going beyond 6 months. And therefore, on the balance 5,70,000. Thereafter, this is the balance 5,70,000 is your LTCG. 5,70,000 is your LTCG. Now comes your IFOS. Now in IFOS, students, you will take the first. I have made a compartment of the three income which will assess under Chapter 12A. 3 income accessible under Chapter 12A, and 1 income, though not accessible under Chapter 12A, but still would be assessed under 115A because this person is a non-resident, which is 5,90,000. So that way you will get a total income, and the tax liability I already told you. Investment income. Which investment income, students? Investment income are 4,30,000. On 4,30,000, 20%. And long-term capital gains 5,70,000, 10%. And on the balance interest income, still it is 115A at 20%. Just keep that in mind. There is a correction required here, and that way, students, you will get your answer. That way, you will get your answer. Then you will get your HEC, and then that is how the things. TDS have. Students, just always keep in mind the TDS that you have to reduce would be after the tax after HEC. Keep in mind this, students. The TDS that you have to reduce is tax after HEC. From that amount, that the amount of TDS has to be reduced. From that amount, that the amount of TDS that has to be reduced. With that now, students, let's come to the last one. Last one, students. Taxation of ADR and GDR, students. ADR and GDR. Let's have a look, students, to this one. This context, and we are done with this one now, students. Next 10 minutes are important, students. Next 10 minutes are important. Just allow me 2 minutes break, students. 2 minutes break. So students, all ready? Now students, in this case, the case of the ADR and GDR students. Now here in this regard students, one particular point I just want to, before I go do this ADR and GDR in FI, one point which I just want to bring to your notice students. Just keep this sentence in mind, students. Interest or interest income on security, interest income of non-resident, just write like this. I'm just writing it properly. Just all of you copied on this one, students. One line, only one line. Interest income on the bonds or securities notified. Interest income of a non-resident. Interest income of non-resident and bond or security notified by the central government. So this is 10%. This is 10%. Just keep this point in mind, because sometimes and many a times they have targeted it as one of the case wherein whenever they will give you a bond is there, and from that bond there is an interest income which is earned by a non-resident. Then in that case, this interest income, students, would always be taxable at the rate of 10%. Always students will be taxable at the rate of what? 10%. Just keep that in mind. Okay. Now coming to the ADR and GDR, students, this chart is complete. So students, what happens in the case of ADR and GDR? Always keep in mind this. First of all, the non-resident will be investing in the ADR and GDR of the Indian company. The non-resident will be investing in what? In the ADR and GDR of the Indian company. That is point number 1. And thereafter, students, be careful. Thereafter, if that ADR and GDR has been transferred by one non-resident to another non-resident, then in that particular case we will see that this will not be considered as a taxable transfer. That is, it is covered under section 47. This will not be considered as a taxable transfer, students. That is in this case it is covered under section 47. So not a taxable transfer and therefore covered under section 47. But whereas if it is transferred to a resident person, so a non-resident is transferring the ADR and GDR to a resident person, then the capital gain arising on such transfer will be taxed at the rate of 10%. Now, no indexation whatsoever, students. No indexation whatsoever. Keep this in mind. So the benefit of indexation in this particular case will not be available. Is that clear to all of you, students? The second particular point, so this is the first one, the sale of ADR and GDR. The second one, students, is the redemption of it. Like for example, here, now please, there is a comparison which I will give it to you. Just pay attention on the comparison also. Let's look upon to this. What is this redemption of GDR? Meaning thereby, the non-resident is giving the GDR or surrendering the GDR to that company, and the company will be giving its shares to the non-resident. Non-resident will be surrendering the GDR or ADR to that particular company who has issued the ADR, GDR, and that company in exchange of this will issue its shares to this particular non-resident. Now this conversion of ADR and GDR against the shares received from that company, this is taxable, students. Why I am emphasizing on its taxability? Because there are two cases which you may be aware. Conversion of a preference shares into an equity shares. Remember? Conversion of a preference shares into an equity shares, or the conversion of debentures into an equity shares is not considered as a taxable transfer. But in the case of conversion of ADR and GDR to receive the shares of the company, is this considered to be a taxable transfer? And the answer is yes. This is very much considered to be a case of a taxable transfer. Capital gains will be calculated. Now please understand, when you calculate the capital gains on the transfer of ADR and GDR, it will be considered to be a long term or short term. That will depend on the period of holding. That will depend upon the period of holding which should cross the threshold of 36 months. That will depend upon the period of holding which should cross the threshold of 36 months, students. I hope that every one of you are clear with this one. Now, what is the full value of consideration for this non-resident? The value of the shares that they have received, and then less the cost of acquisition of the GDR, and whatever is this, you will apply the rate. Now subsequently, when the shares are transferred, then this is the third one, on the subsequent transfer of the sale of shares that the non-resident has received in the point number 2. So if subsequently that they will transfer the shares, then in this context, the full value of consideration to determine if it is long term or short term would be 12 months. Point number 1. Secondly, students, the selling price, whichever is the amount that you have received on sale of that shares, that is the selling price that will be considered. Cost of acquisition would be considered as what? Now the cost of acquisition would be whatever was the value which was being considered for the purpose of conversion of GDR into the shares. That value will become the cost of acquisition. Whatever was the value which was being taken into account at the time of the conversion of ADR and GDR into the shares, that value, students, that value, in this case, that value would be the one which would be there in this context. I hope that every one of you are clear with this one. All of you. So this is all the things has to be looked upon. Now with this, students, we are done with this particular part. Now let's come to the last one, students. The last one, and this is the last one, which is the FII taxation. The FII taxation. The FII taxation, students. So in this context, students, here if you see, foreign institutional investor 115 AD. Foreign institutional investor, students, 115 AD. So let's have a look, students, over here. Many students are saying that it is difficult to buy at the FII rate. Don't worry, students, I'll simplify for all of you. These rates, which many students are thinking it's very difficult. No, it is not. Students, just remember this. Just remember what is the normal rate of tax. Normal rate of tax as applicable to a non-resident. Normal rate of tax which is applicable to a non-resident. Just think of that. So if I look into this one, dividend income, students, interest income, just visualize 115A. Dividend at 115A, students, is at 20%. Just go with that. Forget this part. Forget the specified fund. Just focus on the normal 115A rate. at the normal 115A rate, as we all know. Dividend, it is, how much is that for dividend? Dividend, students, it is 20%. Okay, what about interest? Students, interest, we have got two rates. One is 20%, another is 5%. The 5% which is there, students, you may be aware there are three securities on which, if the non-resident is receiving interest income, three securities on which, if the non-resident is receiving interest income, then on such interest income, the applicable rate of tax would be 5%. Which are the three securities? Number one, interest on the long-term infrastructure funds or bonds. Interest income on what? The interest income on the long-term infrastructure bond, students. That is point number one. The interest income on what? On the long-term infrastructure bond. That is point number one. Point number two, students, if you see, is in respect of the interest income on the rupee denominated bonds. Rupee denominated bonds. And the third point, students, is the interest income received from the business trust. Received from what? From the business trust. So in all the three cases, the rate of interest at which the tax, so rate of tax on this interest income would be at 5%. For all the remaining interest income, students, the rate would be 20%. The rate would be 20%, and that is what has been shown to all of you over here. So this is at 5% and this is at 20%. Clear with this one? Short-term capital gain, again, look into the special provision. And what is a special provision, students? The special provision is 15% rate. 15% rate. And the second one, students, is if the short-term capital gain satisfies the condition of 111A, namely the securities which is transferred in recognized stock exchange on which STT has been paid, then in that case the rate would be 15%. Other than that, the rate would be at 30%. Other than that, the rate would be at 30%. Isn't it? That is how the things has to be considered. So far as LTCG is concerned, students, LTCG, again, go with that 112A. So they have said, if FII has got the LTCG which is covered under 112A, then the benefit of 112A would be applicable. And what is that? 10%. What is that? 10%. Other than 112A, students, other than 112A, any other long-term capital gains would be at 10%. Okay. Now, whether long-term capital gains, whether it is covered under 112A or it is not covered under 112A, in both the cases, students, no benefit of indexation would be available. No benefit of indexation would be available in this case, students. So can you see this one? The benefit of indexation is not available at all. So whether it is covered in 112A or not, the benefit of indexation is not available at all. Now therefore, as I told you, here in 112A, if it is covered 10%, now also said, sir, what a difference? Difference you all are aware. If it is 112A, students, you all are aware, then in that case, no benefit of, in that case, there is an extra 1 lakh exemption which is available. There is an extra 1 lakh exemption benefit which is available, students, if it is covered in 112A. And that is a point, students, over here. Now, this is how the things is being covered over here, students, in this context. Now, one last point which I just want to tell you. Students, in the capital gains front, remember the surcharge, there is a relief from the higher rate of surcharge of 25% and 37%. There is a relief from the higher rate of surcharge on this relief on the higher rate of surcharge. I think all of you are aware. Keep in mind this point, students, for the last time that you are doing it. So, higher rate of surcharge, students, in this context. Non-applicability of the higher rate of surcharge. Non-applicability of the higher rate of surcharge. Why shouldn't? Non-applicability of the higher rate of surcharge, students, just pay attention over here. If individual HUF, higher rate means 25% and 30%. Higher rate would mean 25% or 30%. Individual HUF, AOP and BOI. Individual HUF, AOP and BOI. I'll keep this as in one category. FII and FPI. Foreign institutional investor, foreign portfolio investor. Now students, always be very careful. If short-term capital gains under 111A and long-term capital gains under 112A, just keep that in mind. In this context, where the total income, students, excluding the above income, exceed rupees 2 crores, So the answer is no or yes. Then surcharge on the surcharge on the total tax would be at the rate of 10% or 15%. But if the answer is yes, this is what it would be. Split it. Surcharge on the tax on above income, at 10% or 15%. Surcharge on tax on balance income at 25% or 37%. 25%, students, all of you are aware, if the total income is exceeding 2 crores and if the total income exceeds rupees 5 crores. Okay, so therefore, students, this is how it would be. So you have to check whether, excluding the above two income, whether your total income is exceeding 2 crores. Excluding the above two income, whether the total income is exceeding 2 crores, this is a question that needs to be answered. If by excluding the above income, the total income does not exceed rupees 2 crores, then the surcharge on the total tax would be at the rate of 10% or 15% depending upon where is your total income. Whereas if even after excluding the above two income, even after excluding the above two income, the total amount, the total income still exceeds the threshold of 52 crores, then the surcharge, students, here at least you can write here, just a second, don't write 10%, write 15%, because already it is exceeding 2 crores, so write 15%. So the surcharge on the tax on the above income is at 15%. At 15%, fine, because already the total income is going more than 2 crores. But for this above two income, the surcharge will be at the rate of 15%. Okay, the normal rate. And on the balance, on the tax on the balance total income, the surcharge would be at the rate of either 25%, wherein the total income is between the 2 and 5, or it would be surcharge would be at 37% if it is going beyond 5. Is that clear to all of you? Now for FI and FPI students, please be careful. There is one more income which is added. Now be careful, dividend income and STCG or LTCG on transfer of, this is important, any securities. This is a fundamental difference, students. On any securities. So now you will have to put across your observation in this context. Dividend income or STCG or LTCG or transfer of any securities. So again the same thing. Where the total income excluding the above income exceed rupees 2 crores. Same, it could be yes or no. When I'm writing same means the same thing which is there in the previous particular slide. The same thing which is there in the previous slide. The previous whatever version that you've done. I'm not repeating it again. I hope that all of you are clear with this for now. Every one of you are clear with this. Fine, friends. So we are done with this particular proposition now. Now, students, in this case, directly looking into this question, and this chapter is also over. So let's have a look. XQL, a notified FPI and SS like an AOP, derived the following income from various sources for the financial year 21-22, and what is that, students? 2 crores 80 lakh 50,000. And expense incurred in respect of that is 50,000. So obviously we will, in this case, let's read it further. The above income includes interest of 16 lakhs received from an Indian company on the investment of rupee denominated bond, and dividend income of 3.5 lakhs from a domestic company referred to in section this. Students, tell me, rupee denominated, out of this 2,80,050, 16 lakh students will be the interest income, at which the rate of tax would be 5%. And the dividend income, students, please tell me, the rate of tax would be 20%. The rate of tax, you have just now seen, na? The dividend would be at 20. Interest split between 5 and 20. 5 and 20 for interest. Dividend is at 20, isn't it? So therefore, dividend would be at 20 and interest would be at primary. So interest would be at 5% because it is from the rupee denominated bond. Now, what about the balance or the balance income? Whether 50,000 will this be balance income at 20%, students? So here we can say for the balance income would be at the 20%, students. My question to all of you therefore is this: whether the expenditure of 50,000 students, will that be reduced? This is not your capital gains calculation that you reduce your expenses on transfer. This is not your capital gains calculation that you reduce your expense of transfer. This is your normal interest income. And which is chargeable at the flat rate. There is a special rate of tax at 20%. So if there is a special rate of tax at 20%, where is the question of the deduction of any expenditure? Isn't it? Because all these rates that we have just seen are the special rate of tax. So therefore no question of the deduction of this rupees 50,000. Let's have a look to the capital gains. Long-term capital gains. In this context, students, indexation has been given. Just to confuse you, no relevance at all. 52 lakhs and 28 lakhs. So no indexation, you will reduce it. Short-term capital gains, students. There are two short-term capital gains. In this case, STT has been paid. So in the case when the STT is paid at 15%, and where the STT is not paid, it will be at 30%. It will be 13%. But as far as surcharge is concerned, whether it is a case of 111A or the 30% STCG on transfer of security, the fact remains it is a capital gains on the transfer of security. And because it is a capital gains on the transfer of security, therefore what? Therefore we will say that because it is a capital gains on the transfer of security, students, we will say that. Say what? Indeed, because it is a capital gains on the transfer of a securities, therefore we shall say that. Therefore, students, we shall say, indeed the case, because it is a capital gains on the transfer of security, no higher surcharge of 25% or 37% would be applicable. Okay, just keep that in mind. So, students, yes, Veti, reduced surcharge rate would be applicable. Now, coming to this one, dividend income 3,50,000. Income on securities, so minus dividend income 2 crore 77 lakhs. So 2,80,000. 2,80,000 students. Okay. Long-term capital gains 24 lakhs. Now students, be careful. I have not assumed it is 112A long-term capital gains, students. I have not assumed it is a 112A capital gains. Why I have not assumed that? There is a reason. Because they are silent in the question about the payment of STT in the long-term capital gains. They are silent in the question on the payment of STT in the long-term capital gains, and because that they are silent in the question on the payment of STT in that long-term capital gains, therefore what? Therefore we have not considered that particular point. I hope that every one of you can appreciate this. Okay, perfect, students. So now therefore in this case, so I have taken two without indexation, but even if it is not 112A, and this long-term capital gain has to be calculated normally, even if it is not 112A, and the long-term capital gain has to be calculated normally, students, still no indexation benefit would be available. I hope that all of you are clear with this one. And now then, coming on this part, STCG normal calculation is done, and now comes the tax portion. Please see the tax portion. On that 16 lakhs rupee denominated bond, 5%, 80,000. On the balance other than 16 lakhs, students, will be 20%, including the dividend income, because dividend income is also 20%. Students. Isn't it? So therefore only that 16 lakhs in that 2 crores 80 lakh 50,000, that 16 lakhs in that 2 crores 80 lakh 50,000, that 16 lakhs would be at 55%. Whereas the balance income which is there, the balance income would be at 20% rate. The balance income is at 20% rate, and that is what they are trying to suggest in this case. Now, The long-term capital gains, as I told you, I'm not taking that 1/2A, because if I have to take 1/2A, then 24 lakhs would be further reduced by 1 lakh. So I'm not taking that. So I'm just taking, going normally 10% and 2,40,000. Two STCG. One is at 15% and another is at 30%. So this is what it is. Now let's look upon to surcharge. Now surcharge in this case, be careful on the dividend income and on the capital gains income. So students, on the dividend income and on the capital gains income, because please be careful, the total income, if you see the total income is at, the total income, students, already is at what value? 3,16,90,000. 3,16,90,000. What did I told you? What did I told you about this? I told you that, first of all, for FI, out of 3,16,90,000, please reduce the STCG, LTCG and dividend income. So if I have to reduce STCG, LTCG, dividend income, it is 24 lakhs, 8 lakh 32. So this is 32 lakhs, 32 lakhs plus 4 lakh 42,000, 36 lakh 40,000, 36 lakhs 40,000 plus 3.5 lakhs. So 36 lakhs 40,000 plus 3.5 lakh students, which becomes the case for 39.9 lakhs. So if I have to reduce 39.9 lakhs from this, still can I say the total income exceed rupees 2 crore? The total income is exceeding rupees 2 crores. Even if I have to reduce 39.9 lakh students, you can just see what is 39.9 lakhs. STCG, LTCG, which is your 24, 8 lakhs, 32 plus 4 lakh 40,000. So 36 lakhs 40,000 plus 3 lakh 50,000, which comes to 39 lakhs 90,000. So even after reducing 39 lakhs 90,000 from 3 crores 16 lakh 90,000, is my total income still going beyond 2 crores? Yes. And because my total income is still going beyond 2 crores, therefore what did I told you? The surcharge on this tax amount, the tax which you have to calculate would be at 15%. And on the balance, whatever is the tax amount, will be at 25%. Would be at 25%. So this is how it would be considered in this case. So that is what we have done. So capital gains and dividend income, 39, the tax amount is how much? 2 lakh 40. For LTCG, STCG, 1 lakh 20, 1 lakh 20. 1 lakh 20 and 1 lakh 32. And this 70,000 is from dividend 3 lakh 50. From dividend 3 lakh 50, we have taken 20%. 3 lakh 50, 20% is 70,000. So therefore, the surcharge on these would be at 15%. So take the total, probably, which is 5 lakh 62,000, and take 15%, will give you 84,300. And on the balance total income, now the tax on the balance total income. So the tax on the balance total income, now whatever is the tax amount, 58 lakh 62,000. 58 lakh 62,000 is the total tax. From this you reduce the above tax. What is the above tax? We just now have calculated the above tax. So reduce those tax amount, and on balance, which is 53 lakhs, students, therefore on that 53 lakhs, 25%, which will give you this, and then HEC, add this, take the subtotal, and this is how it is. So with that, students, we are done with this completely now. I hope that all of you are clear with this one. Now we go to the amalgamation and demerger, students. We go to the amalgamation and demerger. Let's start amalgamation demerger. Capital gains implication. As I told you, students, I'll be doing the practical questions on the amalgamation demerger on CG, and finally the exemption. Exemption hardly will take time. These are small things. Half an hour more. We are done with this, both the things together. So this is question number 163 in the compiler part. Surcharge will be at 80,000. No, the dividend income is 350, na? 3,50,000. So the dividend income is at 350. And the fact that the dividend income is at 3,50,000. 20% of that is how much? 70,000. 3,50,000 is a dividend income. 20% of that is 70,000. So surcharge on the dividend income of 70,000 is at 15%. This 80,000 is this one. You're talking about this 80,000 is this one, which is the interest income. On interest income, the surcharge is at normal. The only the surcharge is at higher surcharge. The only the lower rate of surcharge, the normal rate of surcharge is applicable for dividend income and the capital gains income. The tax on the dividend income and the tax on the capital gains income. On all the other income, the higher rate of surcharge would be applicable. So even that interest income, the higher rate of surcharge is what would be applicable. Now, so it's couple of questions, quick questions over here. SS Private Limited, a domestic company having two undertakings, engage in manufacture of cement and steel, decided to give off cement division to RV Private Limited domestic company by way of demerger. So it's a case of a demerger, students. The net book value of assets of SS Private Limited before the demerger was 40 lakhs. Now this is important, students, because we have to cover up the cost of acquisition. Some calculation would be required to be done. So the net book value of the asset of SS Private Limited before demerger was rupees 40 lakhs. The net book value of asset transfer to RV Private Limited was rupees 10 crores. 10 crores, students. So this is what it would be. The demerger was made on Jan 2022. In the scheme of demerger, it was fixed that for each equity share of rupees 10 each, fully paid up of SS Private Limited, 2 equity shares of 10 each, fully paid up, were to be issued. Okay, so that is out of 1, you will be giving 2 in the resulting company. Okay, so therefore, out of the 1 in the old company, you will be getting 2 equity shares of the resulting company, which is RV Private Limited. One Mr. NK held 25,000 equity shares in the old company, that is a demerged company, which were acquired by him in 5/6, so it's a long term already, for rupees 6 lakhs. Now students, here whether the period of holding for this, will this be for the resulting company for which the shareholder will receive the shares, the period of holding, will I consider it from Jan 2022 or will I be considering it from 2005-2006? From which date the period of holding would be considered for the cost of for the shares which you have received of the resulting company? Whether the period of holding would be considered from Jan 2022 or whether the period of holding would be considered from the financial year 2005-2006. To that the answer is, students, from 2005-2006. That is what I have received, the shares of the resulting company, which is RV Private Limited. I will be taking into account the period of holding from the date when the original share was acquired, and therefore this is what would be considered in this regard. Yes, 5/6. So Mr. NK received 50,000 equity shares from RV Private Limited consequent to demerger in January 2022. He sold all the shares of RV Private Limited for 8 lakhs in March 2022. In this background, you are required to answer the following. Now be very careful here. Students, one point I want to bring to your attention. Point number 1, does the transaction of demerger attract any income tax liability in the hands of SS Private Limited and RV Private Limited? SS Private Limited, students, who is transferring the undertaking to the resulting company RV Private Limited. RV Private Limited, the fact that it is a domestic Indian company. The fact that RV Private Limited, the transferee company, is an Indian company. Therefore, the provision of Section 47 would be applicable, and hence no capital gains tax will arise in the hands of SS Private Limited. No capital gains tax will arise in the hands of SS Private Limited. Now, what about RV Private Limited? Because they are asking the question for both income tax in the hands of the transferor and in the hands of the transferee. Now, for the transferee, the question that may arise is the applicability of the gift tax provision. The question that may arise, students, for the recipient company is the applicability of the gift tax provision. So whether the gift tax provision, is it applicable in the hands of the recipient company? And the answer is no. The reason being, in the gift tax provision there are certain provisos. In the gift tax provision there are certain exclusions, and one of the exclusions in that gift tax provision is that the asset which is received, or the shares which are received on account of the amalgamation and demerger, those assets or the shares so received will not be considered for the purpose of the chargeability under Section 56(2)(10). For the purpose of chargeability under Section 56(2)(10). So therefore no gift tax provision would be applicable in the hands of the recipient RV Private Limited. State the condition in brief which are to be satisfied under the Act of a demerger. Students, you can just quickly read the theory. 1 to 6 for the last time. Fine, students. Now let's have a look to this one. Point number 3. Compute the capital gains that could arise in the hands of Mr. NK on the receipt of the shares of RV Private Limited. So obviously on the receipt of the shares, no capital gains. Same thing, not taxable transfer. Why is it so? Because they have received, in this context, the shares in the case of their demerger. Students, but be very careful on this one particular point. Instead of that, they may also ask you, what is the tax implication? This, see, ICAI is very intelligent in the drafting of the question. Instead of asking you the capital gains, if they ask you this, that what is the tax implication in the hands of Mr. NK? Okay, what is the tax implication in the hands of the NK on the demerger? So you will have to write 2 points. Point number 1, whether any capital gains implication will arise. Whether any capital gains implication will arise, answer is no. 47 covers the shareholder as well, who receives the shares in consequence of demerger of the resulting company. So therefore, in that case, there is no capital gains implication in the hands of the resulting company. No capital gains in whose hands? In the hands of the resulting company, students. Point number 1. Coming to point number 2, students, be careful. The second particular point, students, in this could be on the gift tax. Because they are receiving the shares of the resulting company, you will say that it is also excluded from the applicability of the gift tax provision under section 56(2)(10). So both of the points you need to cover it up if they ask you what is the tax implication in the hands of the shareholder. Thereafter, subsequently, students, NK has transferred the shares of RV Private Limited. So he sold the shares, all the shares have been sold for rupees 8 lakhs. Isn't it? Now, in this context, 50,000, now he has held 50,000 shares in SS Private Limited. So he has received 1/2. So 1/2 means 50,000 shares he has received. Entire 50,000 has been sold. Now, obviously, what will be the cost of acquisition of this 50,000 share? Now, please be very careful. The cost of acquisition would be the original cost 6 lakh rupees. And this would be subject to the pro rata calculation. And that is 1/4. How did I got 1/4? 1/4 I got in this case is that 10 crores is the net book value of the asset transferred, 10 crores. And the net worth of the SS Private Limited before the demerger was rupees 40 crores. So 10 crores is what you have transferred. Your own net book value before the demerger was 40 crores. So 1/4 becomes the proportion of the resulting company. 1/4 becomes the proportion of the resulting company, and therefore on 1/4 probably is the proportion applied on your cost of acquisition of your shares of the demerged company. So the cost in this case will become how much in this case? 1.5 lakhs. Now you have to give the indexation benefit. You will have to give the indexation benefit, isn't it? So indexation benefit has to be given. And indexation from 5/6. We already discussed this point, students. Indexation would be from 5/6. And this is how it has to be considered. Last point, students, which is there. Will the sale of shares by NK Limited affect the tax benefit availed by SS Private Limited or RV Private Limited? Answer is no. Such particular condition or the criteria is not there. Such condition is not there. Students, this kind of a condition is there for the partnership firm or a proprietary firm which is getting converted into a company. Because what happens when you partnership firm or a proprietary firm, if they are converted into a company, then there is one condition. Do you remember the condition? That the proprietor or all the partner should hold 50%, more than 50% of the voting power in this company, and that too for a period of 5 years. This is one criteria. So there the question of any particular partner or the proprietor transferring the shares of the new company, then you need to check this condition whether there is a reduction of 50% or not. Because if there is a reduction of 50%, then the capital gains which was exempted earlier in the hands of the proprietary firm or a partnership firm, that capital gains which was exempted earlier will now become taxable. This is how, students, we all have considered in this case. Fine. This is how we have all have considered this case. The second particular point which has been there, students, over here. The second particular point, students, which has been there over here is in respect of what? Now the second particular point, students, if you all will see, is in respect of the holding company 100%. to its subsidiary company. So the holding company transferring it to its subsidiary company. The capital asset has been transferred, students. The capital asset has been transferred. So where the holding company transfers the capital asset to its subsidiary company, and that transfer is on the 100% this time. The transfer is of the 100%. So they have to ensure that the condition is that, or vice versa. So what is the condition? The condition, as you may be aware, that for that 8 years period, for the exemption is there, 47 exemption is covered over here. All of you may be aware that there is a 47 exemption. So for the 8 years period, the holding company should not cease to be 100% holding company. So the shareholder holding their shares, students, holding their share is a condition which is applicable in respect of these 2 points. But in the case of amalgamation or in the case of demerger, students, always keep in mind in the examination. In the case of amalgamation and demerger, the shareholder holding their share is never a condition that needs to be looked upon. I hope that all of you are clear with this point. Every one of you. Okay, so therefore here, if Mr. NK has sold the shares, then the company which has claimed the exemption, which is SS Private Limited, that company will not have any impact so far as its earlier exemption is concerned. That company will not have any impact so far as its exemption is concerned. Fine. Now students, on this capital gains which NK has got on the sale of the resulting company shares, on that capital gains, can Mr. NK do anything to claim an exemption? And the answer is yes, he can do the necessary investment. And we have defined 54EE, 54F. I am not writing 54EC here, because 54EC exemption, students, as you may be aware, is applicable only in respect of the immovable property. The 54EC exemption is applicable only in respect of the immovable property, students. I think every one of you are aware of that. So therefore, over here, this concept will not be applicable. Fine, students. All of you. That exactly is the point, students. So we have done with this particular proposition now. Now this last question, students, Kalpesh, and we are done with this completely. 163, 164, 165. Because 165 is for the 54 exemption, which is a really good question. 54 along with this ATIAC. So let's have a look over here. Two last questions of the day. Conversion of a private limited company to the LLP. Conversion of the private limited company into the LLP, students. So here, students, Kalpesh Private Limited was converted into the limited liability partnership called Kalpesh LLP on 1st of July 2021. You are provided with the following particulars of Kalpesh Private Limited as on 31st of March 2021. And what is that, students? Unabsorbed depreciation. Now, students, as you may be aware, the implications are that whatever is the unabsorbed depreciation, whatever is the, be careful, brought the business loss, whether the unabsorbed depreciation, whether the business loss, can that be carried forward in the hands of the successor? Yes. Students, only one very important point that you should be considering is this. In the case of demerger only, be careful, students. The previous case. So, only one very important point. In fact, that they should have targeted in this question. In the case of demerger, they could have given that what was the loss? What was the loss of the cement division? What was the loss of cement division? Because it is a cement division of SS Private Limited which has been transferred in a demerger to RV Private Limited, and now that RV Private Limited is a resulting company. So supposedly, if in this question they would have given the loss, business loss of the cement division, then in that case it will now be eligible to be carry forward in the hands of RV Private Limited. It will now be eligible to be carry forward in the hands of the RV Private Limited under section 72A. Now this in section 72A, the carry forward, would it be for another period of 8 years? Will that be the criteria? For another period of 8 years, will the carry forward provision, will that apply? Answer is no. The carry forward provision, students, will not be for the another period of 8 years. It would be only meant for the balance years. This is the only particular thing which you should be careful by, because in all the other case of business restructuring, namely like what we are discussing right now, conversion of a private limited company into the LLP, or just conversion of a sole proprietorship into a company, conversion of a private partnership firm into a company, conversion of amalgamation, case of amalgamating company getting amalgamated to an amalgamated company. In all the remaining cases which you have discussed, the loss of the predecessor, business loss of the predecessor, would be allowed to be carried forward by the successor for another period of 8 years. For another period of 8 years. This is the only one very important point of distinction. Whereas in the case of demerger, it is only for the balance year that the loss can be carried forward by the resulting company. But in all the remaining cases which I have just explained, and in this also question, which is the question of the conversion of a private company into the LLP, in all the cases it will be for another period of 8 years. I hope that all of you are clear with this one. So now if you see over here, friends, Kalpesh Private Limited was converted into limited liability partnership called Kalpesh LLP on 1st July 2021. You are provided with the following particulars of Kalpesh Private Limited as on 31st of March 2021. Unabsorbed depreciation is rupees 13 lakh, students. Business loss is of rupees 10 lakhs. So I told you, now as far as UAD is concerned, you all know it's no limit case. It's a no limit case, UAD. So that is same will be applicable. Business loss relating to 12-13 in this context. I think previous year 12-13. 13-14, 14-15, 15-16, 16-17, 17-18, 18-19, 19-20, 20-21. 20-21. This has to be, students, because otherwise it's lapsed. It would already lapse it. So relating to previous year 13-14. Unadjusted MAT credit under 115 JAA, rupees 8 lakhs. What about MAT credit? Obviously it will get lapsed. And by the way, MAT credit is never carry forward. You all are aware. Even in the case, say for example, there is an amalgamation between the two companies. Is the MAT credit taken over by the amalgamated company? No. So it will get lapsed. The WDV would be important because the WDV of the predecessor is what will be considered further. So you have been given over here, and what is that, students? If you see over here very carefully in this context, students, if you see over here very carefully, then the WDV of the asset as per section 43(6) has been given to you. So all would become the WDV of the LLP. Cost of land acquired in the year 2001, 50 lakhs. SDV is this much and fair market value this much. Doesn't matter. What the cost of land is this much. That is fine. This would be at the book value. Only it would be taken over. Expenditure on the VRS incurred by the company. Expenditure on the VRS incurred by the company students. During previous year 1920 is 25 lakhs. The company has been allowed 5 lakhs deduction. Now whether that balance, will that be allowed? Because 1/5 is deduction under 35 DDA. 1/5 is a deduction under 35 DDA. So whether the balance, will it be allowed to the successor? And the answer is yes. The balance, students, will be allowed to the successor, and that is what has to be considered over here. So students, this is what it is. I think this is simple. Only one point, students, yes, only one point over here is about the depreciation allowance. Last point, students, this is the only good point. Point number D. Students, whether the depreciation, see here, 1st of July it is happening. The conversion took place on 1st of July. So the depreciation for the previous year 21-22, will be calculated normally, students, as if no such conversion has taken place. As if no such conversion has taken place, students. Calculated normally. So calculate for the full year the depreciation amount. Calculate for the full year depreciation amount. So accordingly, in this context, thereafter, once you have calculated, then you do the split. Split in terms of the ratio of number of days. The ratio of number of days the asset was used. Split into the ratio of number of days the asset was used, students. So that needs to be done in this context. And this is what has happened over here also. If you see over here, students, this is what is taking place. 91. By the way, just be very careful. I'm just telling you one important thing. This date, 1st of July, will go to whom? The successor or predecessor? The date wherein the conversion has taken place. The date when the amalgamation is taking place. Will go to the successor or predecessor? Successor, students. So if you see for the predecessor, it is April 30, May 31 and June 30 for the predecessor. So in all 91 days, and that is the reason why this is how it is. So plant and machinery depreciation 1,50,000, 91 divided by 365. Building 2 lakhs, 91 divided by 365 goes to them, and the balance goes to the other one. So this is how it has to be considered. That exactly is the point. Now friends, this is how the things has to be looked upon. Students, now my humble suggestion is that from the compiler, all of you will go through question number 165 straight away. Straight away, students, all of you from the compiler will go to 165, and please close this discussion. 165 directly, students. 165 question. All of you go through this one. Question number 165. Straight away you'll refer this, and that's it. Students, tomorrow night, the case law 2 hours video would be put up. The 2 hours case law video would be put up. You will have to see that without fail. That is a recorded one, but that 2 hours case law video would be put up tomorrow night. Without fail, students, you need to have a look over there. Is that clear to all of you? Fine, students. So we are done with this session, students. In this context, one quick announcement I will make about the batch. Please do tell to your friends, students, about this one. One batch which has been there, students. Have a look. All-star batch, students, for the November 2022. For those who would have May 23 also can join it. For them, students, they can do the May 23 students can do amendment separately. All-star batch, it's a 100% English batch, students. November 22, May 23. So they May 25th, May 2022 it starts. DT would be taken by me, IDT would be taken by Mohammad Rafi sir, SMP would be taken by Devan Kothari sir. So this is what it would be. And more importantly, students, you have to use the referral code CADS. Students, you have to use the referral code CADS in order to get the 10% discount. Is that clear to all of you, students? You have to use the referral code. Tell your friends to use the referral code CADS in order to get this 10% discount on the same. So this is what it would be, students. And that exactly how the things are there. Starts from 25th of May. This is regular batch, students. This is the regular batch. Okay. So please do let your friends know about it. And I'll see you, students, tomorrow. Take care. Bye-bye.